Are qualified plans destroying your retirement? Well, let's talk first about what is a qualified plan. IRA, 401k, 403b, 457, defined benefit plan, TSP, anything where the government is your partner. Now, if we're going to talk about that, then we need to have a little bit of contents about where we are, where we've been, and where we're likely to go. So let's start with this question. What is the highest income taxes have ever been in the United States since the inception of the temporary income tax and the establishment of the IRS in 1913? And the answer to that question is 94%. 94%. Can you imagine being in a 94% tax bracket living in the state of California today? You would actually write a check for 8% to go to work. I used to think that my father was nuts in the 70s. He would tell me that, look, I'm not going to work today because if I go to work today, I'm going to pay it all out in taxes. And I thought he was just completely ignorant. I mean, what kind of a statement is that? Yet in the 70s, between the state and the Fed, he would have been paying out 75% in taxes. So now I understand what he's talking about. So we've been as high as 94. We're currently at 37, and the average since the inception of the temporary income tax and the establishment of the IRS in 1913 has been 94% with an average of 57. Now, real quickly, we got a national debt of about $37 trillion. We got an unfunded deficit for Social Security, Medicare, and prescription drugs about $227. We spent about $2 trillion more than we brought in. So I don't know. What do you think? You think taxes are going to be lower, higher, or the same in the future? And if you're like everybody I've ever talked to, you believe taxes will be higher in the future. So the big question is, do you want to pay them? And is it really a good idea to be taking money and deferring it inside of an IRA or 401k or a qualified plan out to the future where you believe the taxes will be higher? You see, it really only does two things. It defers the taxes and it defers the calculation. So you've done this great job. You've got $1 million sitting over here in your 401k. But my question for you is, have you ever seen the after-tax statement? Well, they didn't send that to you? Well, here, let me show it to you. It looks just like this. See, you believe that this is all your money because when you look at the statement, that's what you see. And the government believes this is all their money because when they look at the statement, this is what they see. And until you pay them your portion, then that money belongs to them. So when do you want to pay them? At what point do you want to fire your business partner? What point do you want to control your tax rate? Now, see, you're playing a game. You don't realize it, but you're playing a game. And the game that you're playing is called accumulation. You're over here in your 20s, your 30s, your 40s, 50s, 60s, and even 70s, and you're still accumulating money. And the market's going up and down and up and down and up and down, and it's no big deal. You remember 2000, 2001, 2002, 2008, 2022? Hell, do you remember June of this year? See, the market goes up and down, and that's no big deal. And the reason why it's no big deal is because all you have to do is wait. But you're going to move into my world, which is distribution and preservation. And over here, the market's still going to be going up and down and up and down. But there's going to be one major difference between your accumulation world and your distribution world. And the difference is, over here, you had a paycheck. So when the market went down, you just waited. And the market always came back because you didn't have to touch this money. But when you move over here to the distribution and the preservation stage of your life, and let's just say for the sake of argument that you need $60,000 a year, and the market makes 6%, life is good. 6%, life is good. And in just 1 year, just one, the market loses 20%. Well, how much do you have left of your $1 million if you lost 20%? Well, see, most of you probably just said $800,000. But the reality is you forgot. You still got to take the $60,000 because you need money to live on. So now you're down here at 740, and you're not going to recover. And see, it is not a question of if the market is going to go down in retirement. It's only a question of how many times will the market go down in your retirement, and how far down will it go, and can you survive that? Now, don't get me wrong. If you've got a qualified plan, an IRA, a 401k, a 403b, a 457, a defined benefit plan, TSP, there's company matching. There's legal federal protection against this account with regards to lawsuits. You can put quite a bit of money in it. It still has limits, but you can put quite a bit of money in it. And it forces you to save money. However, every good has a bad. So the first bad is if I decide to take money out of these accounts prior to 59 and a half, I'm going to get charged a 10% penalty. The second bad is I'm deferring the taxes. Now remember, I'm not just deferring the taxes. I'm deferring the tax and the calculation on the tax out to a point in the future where we just talked about the fact that the rates will be higher. Then there's come along this little thing called RMDs, required minimum distribution. All of a sudden you have to start taking it out. And if you don't start taking it out, starting at age 72, 73, or 74, depending upon your age, there's a 25% penalty. In addition to that, there's a lot of hidden fees that are inside of it. They have limited investment options, and it's the worst possible money you could ever pass on to your children. It's like, here you go, kids. Here's $1 million. Oh, be sure to pay the government their portion. Oh, by the way, if we're subject to estate taxes, we're going to have to pay that too. And then all of a sudden, our $1 million looks like this. So is it really the best way to be planning for our retirement? Maybe, maybe not. But definitely we want to be putting in the company match. But are you aware that in most ERISA plans out there, 401ks, 403bs, so on and so forth, today there are Roth components. Have you considered whether you should be using a Roth component or not? Have you sat down and done a full-blown analysis of where you're at, where you're going, and what your taxes will look like in the future? Oh, I know they told you you should put money in a tax-deferred account because you're going to be paying money on taxes you would have otherwise paid in taxes, or growing on money you would have otherwise paid in taxes. And in the end, you're going to have more money because you're going to be in a lower tax bracket. Well, is it true? You better hope not. So really, what is qualified money? Well, it's tax deferred. The only exception to that would be Roth IRAs, which is also tax-free, but it's also qualified money. IRAs, SEPs, 401ks, 401as, 403bs, 457, defined benefit plans, TSP accounts. There's penalties for taking them out prior to 59 and a half, and you must start doing RMD. Now, non-qualified money is taxed as you earn. It's not a government plan. It's some exception on tax with regards to bonds, okay? And it's things like certificates of disappointment or CDs, stocks, bonds, mutual funds, etc. Now, let's talk just real quickly on RMDs. The new rule on RMDs took it from 70 and a half to now 72 to as high as 74 with the current rules. But the one thing that we can rest assured about rules and the government is they're likely to change. And when they change the rules, do they change them for your benefit or do they change them for theirs? So let's talk real quickly about Roth and compare that to an IRA, all right? So an IRA, we put the money in tax-free contributions, okay? So we don't pay any taxes on it until we take it out. There's a penalty for taking it out prior to 59 and a half. We have to take RMDs. There's a 25% penalty for not taking the money out in RMDs. We're taxed at distribution. Our Roth IRA, we pay taxes on it today, so we pay taxes on the seed and not on the harvest. The principal is liquid from day one as long as it was a contribution. Now, if it's a conversion, that's not true, but if it was a contribution, it's liquid from day one. It's tax-free after 59 and a half or 5 years, whichever is longer. There are no RMDs, and it passes on tax-free. The only tax it would be subject to would be estate taxes. So some of the Roth benefits are tax-free income, no RMDs, you can still have your money in and put money in over the age of 72 as long as you're still working. Roth conversions cannot be reversed, okay? It used to be you could do what was called a recharacterization. Well, these days, if you make a Roth conversion, you're stuck with that. Roth IRA funds pass on to your heirs tax-free. Beneficiaries can stretch them for up to 10 years. This is also true of your ERISA plans. No taxation on distribution at trust rates. And removes the uncertainty of which future tax rates might be, offsetting the losses of the market. So, should you convert? Should you not convert? Well, the bottom line here is when it comes to conversion, the thing that you should consider is this. What tax bracket are you in today? And what tax bracket will you be in later on down the road? 10, 15, 20, 30, 40 years down the road. And just about everybody I've ever sat down with realizes that they're not going to get to a lower tax bracket. And if they're married, it's almost guaranteed. Because currently, they're filing in a joint status. And when they take the money out in a joint status later on, they may get to a lower bracket. However, if one of them dies, now they have to file single. And in most cases, they're in the same or higher tax bracket. And this is assuming nothing happens with tax rates. And if you know where tax rates have been, you know where the national debt is, you got to believe that in the future, tax rates will be higher. So anyone who's younger has a traditional IRA, beneficiaries of IRA is a trust. Wealthy people who don't need it, want it, or likely not use RMDs, these are all people that should be converting their money over. If you believe that you will be in the same or higher tax bracket in distribution years, pay the taxes today. Get it out of there, fire your business partner. Now, whether you pay the taxes out of your IRA or you pay the taxes out of outside money is to be determined. And if you want to know more about that, we actually have a course out there just on Roth conversions. Be sure to visit our website and take that course on Roth conversions. Now, there really only are 3 ways to grow your money. You can grow your money over here, tax as you go. You can grow your money over here, tax deferred and tax free. Which is the worst way? And the answer is tax as you go. This is your cash, your checking, savings, CDs, stocks, bonds, etc. Tax deferred, your qualified money, IRAs, 401ks, 403bs, 457, defined benefit plans, and tax deferred annuities. And tax free, 529 plans, Roth IRAs, muni bonds, and properly maximum funded life insurance under TEFRA, DEFRA, TAMRA. So the question you want to be asking yourself is, what is my tax bracket going to be in the future? What are my taxes today? And what should I be doing going forward? You should be thinking proactively. And if you actually believe that your accountant is taking care of this, then I would ask you this question. When is the last time your accountant came to you in August, September, October, November, or December and said, I've got an idea on how to save on taxes this year? Chances are that's never happened. And if it has happened, then you need to hang on to that accountant because we call that a unicorn. And unicorns are pretty rare things. Accountants, on a whole, do tax planning in the rearview mirror. You come into them in January, February, March, or April, and there's not a lot of choices as to what you can be doing there. We can help you because we play the second half of the game. Remember, you're in the first half of the game, accumulation. You got to move to preservation and distribution. And that game is played very, very differently. We're all about safety and predictability. And basically, it boils down to this. You want to live the lifestyle you've become accustomed to, adjusted for taxes and inflation, out beyond yours and your spouse's life expectancy, and then pass your money on in the most tax-favored way possible. If you like this, share it. Comment. Let's hear your comments. What do you believe? Where are you? Are you in the accumulation stage? Are you in the preservation, the distribution stage? Or have you got all your money over into Roth IRAs? Are you being proactive? Are you being reactive? Where are you in life? And do you really have a plan? Or are you just hoping that putting this money away, it'll all work out in the end? So remember to live like you're going to die tomorrow and plan like you're going to live forever, because you just might. Be sure to subscribe to our YouTube channel below. Keep smiling, and I look forward to seeing you very soon. Be sure to subscribe. Hit that button right down there.